February 4th, 2026. Global markets woke up to a bloodbath. $285 billion wiped out in a single trading session. Indian IT stocks crashed nearly 7%. Infosys, TCS, Wipro, all plummeting. Wall Street dubbed it the SaaSpocalypse. The culprit? Not a recession, not tariffs, not inflation. An AI tool. On January 30th, Anthropic, the company behind Claude AI, released something that shook the entire tech industry. Claude, Cowork, and 11 specialized plugins. But here's what makes this different. This isn't just another chatbot. Claude Cowork is what's called an agentic AI. Instead of just answering questions, it takes action. It completes tasks autonomously. Give it access to a folder, and it can read, edit, and organize files, draft legal contracts, build financial models, analyze data and create presentations, automate sales workflows, handle compliance reviews. The 11 plugins target specific industries: legal, finance, sales, marketing, data analysis, customer support, and more. Anthropic built this tool in just 1.5 weeks using its own AI. Think about that. AI building AI tools that replace human work. The market reaction was swift and brutal. In the US, Thomson Reuters crashed 18% in one day, its worst drop on record. LegalZoom plunged nearly 20%. The software industry ETF fell 5.7%, worst day since April. Salesforce, already down 26% this year, fell further. In Europe, Relix, owner of LexisNexis, dropped 14%. FactSet fell double digits. Advertising giants, Publicis and Omnicom, tumbled 9 to 11%. In India, the carnage was devastating. 2 lakh crore, that's nearly $25 billion, erased from Indian IT stocks in one session. Infosys, down over 7%. TCS, down 7%. Wipro, HCL Tech Mahindra, all down 4 to 6%. The Nifty IT index saw its worst day since March 2020. Globally, nearly $285 billion vanished from software and IT services companies.
So why the panic? 3 fundamental fears converged. First, the SaaS model is under threat. Software companies charge per user, per seat. But if AI can do the work of 10 employees, why would companies pay for 10 licenses? The entire subscription model that built Salesforce, Microsoft, and Adobe is suddenly vulnerable. Second, Indian IT's billable hours model is exposed. Companies like TCS and Infosys make money by deploying human expertise, charging for time and headcount. Claude Cowork automates exactly those tasks: contract reviews, data analysis, compliance checks, work that generates billions in billable hours. Third, this isn't just a productivity tool, it's a replacement. For the first time, investors are treating AI not as a helper that makes companies stronger, but as a direct competitor that could make entire business lines obsolete. As one analyst put it, AI has gone from a tailwind to an existential threat. If you're an investor, here's what you need to know. Short term, this is repricing, not collapse. Some analysts believe the sell-off is overblown. Human oversight will still be needed. Integration into complex corporate systems requires expertise. Medium term, expect volatility. As AI tools evolve rapidly, market reactions will remain sharp. Companies heavily dependent on headcount and seat-based pricing face sustained pressure. Long term, winners and losers are emerging. At risk, companies with pure headcount models, commoditized services, and per-seat pricing. Better positioned, firms with proprietary data, high-trust advisory services, and AI-native business models. Investment strategy shifts. Scrutinize revenue per employee, not just revenue growth. Favor companies embedding AI, not fighting it. In Indian IT, look for firms pivoting to outcome-based pricing. Consider AI infrastructure plays, cloud providers, chip makers. Remember, when Amazon disrupted retail, the winners weren't those who denied the change, they were those who adapted fastest. Anthropic CEO Dario Amodei warned that AI could displace half of all entry-level white-collar jobs within 1 to 5 years. This week's market reaction suggests investors are finally taking that seriously. We're witnessing the birth of what some call the universal agent era. AI that doesn't just assist work, but does the work. The question for investors isn't whether AI will disrupt traditional software and services. It's how fast and who will survive the transition. One thing is certain, the SaaSpocalypse of 2026 won't be the last market shock from AI. It might just be the first. So what should you do right now? Don't panic sell, but don't ignore the signal. This market event is telling us something real about the future of work in enterprise software. Stay informed. AI developments are happening at breakneck speed. What seems impossible today could reshape markets tomorrow. If you found this analysis valuable, hit that like button and subscribe for more insights on how AI is reshaping global markets and your investment opportunities. Drop a comment below. Are you worried about AI's impact on your portfolio? Or do you see this as a buying opportunity? I read every comment, and here's your homework. Research one company in your portfolio. Ask yourself, does their business model survive in an AI-first world? If the answer isn't a clear yes, you know what to do. Remember, in times of disruption, fortunes aren't just lost, they're also made. The question is, will you be prepared?